They say the S&P 500 is a thermometer of economic health. Right now, it's not a fever, it's a migraine, throbbing under the pressure of tech fears, tariffs, and tanks in 3 time zones. But if you're watching the signs we are, you'll see something else. A return to confidence, a coiled spring of capital, and a match struck in a cave full of gas. Not waiting for a spark. We're watching fuse and it's already lit. It's like a drunk centipede marching towards a dynamite pile named Q2 earnings. Let's break this down simply. For SPY to create new all-time highs, we don't need hope. We do need strong earnings and stable financials. Why? Because these 2 sectors make up over 50% of the entire index. Tech is the rocket, financials is the launch pad, and everything else is just snacks for the passengers. You don't climb Everest by strapping carrots to your boots. You need oxygen, guidance, and a Sherpa with perfect Wi-Fi. Tech and finance are that Sherpa. Our thesis is simple. Strong earnings stabilize investor confidence. Confidence creates capital flows. Capital flows into growth stocks. Growth leads SPY to all-time highs. And from there, we don't just rise, we ripple. Because the market doesn't always rise like a gazelle. Sometimes it moves more like a rumour at a family barbecue. Slow to start, but explosive by dessert. Look at the data. Q2 earnings estimates have been cut across the board. 15 of 16 sectors saw downgrades. Transportation, autos, energy, all slashed. But tech and finance have now stabilised. And that, my friends, is the heartbeat we trade on. This chart shows how expectations for Q2 tech earnings started high but got slashed. Then they stopped falling, and that flattening, that is confidence creeping back into the markets. If the market is a hospital ward, tech just sat up in bed and asked for some coffee. Everybody else is still drooling in their pillows. We dipped for real reasons. Tariffs, actual wars, trade wars, and the looming game of battleships near Taiwan. This dragged into defensive stocks, staples, utilities, big pharma, but money didn't flee. It ducked. What happens next? The big question that should always be on your lips. As the storm calms and capital rotates back into tech and financials, which is already happening, we will look at big tech earnings stabilization. Watch for financials to follow. Insurance and banking strength is that next domino. This next chart tracks full year 2025 earnings for the tech sector. After that April panic, estimates stopped dropping and even bounced, and that's the signal of a rotation starting. Capital here is like a nervous cat at a fireworks show. It trusts the silence. It starts to climb back into your lap and then starts clawing at the growth stocks. This isn't just about SPY. When confidence returns, it overflows and it hits small caps in strong sectors first. Why? Because they're cheaper, they're faster, and they're hungrier. I knocked up these charts so that you would understand. Q2 earnings were cut sharply, but tech's decline has now flattened. 2025 earnings dropped early and then stabilized, and long-term tariff fears have now dampened. This is why estimates are holding, not rising, but holding, and that is enough. Here is how earnings and revenue have trended and where forecasts go. The important part is that Q2 looks like the turning point, a dip with a potential rebound forming. We're not after a bull stampede yet. We just need the herd stop backing up like a lorry with a broken beeper. So what to watch? Watch earnings like a hawk, as we have been doing here on the member side of the channel and the Discord with excellent equity write-ups. Look for defensive sectors to beat estimates, then track discretionary consumer spending, and finally zoom in on tech and finance. That sequence is your early warning radar for a takeoff in SPY and massive outsized opportunities in small cap stocks in the strong sectors. These annual figures show how earnings are expected to recover throughout 2025, 2026 and 2027. When that 7.2% in 2025 gets printed, it's rocket fuel for SPY. It'll be like watching a souffle rise. The firm base toughening up, then the lid lifts. Only this time, the oven is $50 trillion in equity. The big lesson, the hugely valuable takeaway for you. Here's what to start with. Use earning revisions to predict confidence returning. Use the confidence to anticipate the capital flows. And use that flow to spot momentum in the smaller cap stocks. And use it early. This is trade spotting, not CNBC. Before everybody else says it's safe. You can read the signs first. You know how to trade like a predator, not prey. If you wait for the bell to ring in trading, you're already late to the boxing match. Your job is to throw the punch before the other guys even finish tying up his gloves. If you found this helpful, good. It is. You've just seen how to read the market using nothing but earnings, risk rotation, and the right charts. Because at the end of the day, everything is technical analysis. Like a lighthouse in a fog, I'll keep lighting up these signals. You just need to look. I'm ready, binoculars up, trades loaded, finger on the trigger. All-time highs. They don't shout out when they're about to arrive. They whisper, and you're going to have to hear them first. Watch Trade Spotting. And if you're getting this video late because you haven't yet upgraded to the most popular tier or become a paid member on Discord, imagine how much money you've missed out on because you're not able to properly quantify cost-benefit analysis in such a simple decision. Good traders know to join good traders on good value services like the Rocky Outcrop Discord. www.discord.gg/Rocky Outcrop. Now go get what's yours.